Imagine two friends starting their financial lives at the same time, saving Sam and investor Ivy. Sam plays it safe. He stashes money in a high-interest savings account and feels secure. Ivy takes the step into the market, accepting a bit more uncertainty for the chance of higher returns. Over decades, the math says Ivy should end up far wealthier, not because she's smarter, but because time and compounding work differently on invested money. Yet in real life, most people end up more like Sam, or worse. So is the math broken, or is something else interrupting the story? Today we'll follow Sam and Ivy through the numbers, see where the curve explodes, and uncover why so many get knocked off before it does. Let's meet our characters properly. Saving Sam puts away €200 every month into a safe savings account, earning a steady 2 to 3% after inflation. He sleeps easy, no big swings, no worries. Investor Ivy does the same €200, but into a diversified stock index fund with a long-term real return of about 7%. She knows markets fluctuate, but she stays the course. Now watch what happens over 40 years. For Sam, with a safe real return around 2 to 3%, the numbers move, but they move slowly. After 10 years, he's at roughly 27 grand. After 20, around 60 to 65. After 30, call it a bit over 100. And after 40 years, he lands somewhere around 150 to 185. It's solid, it's steady, but it's a gentle slope. Now Ivy, same €200 a month, but a higher long-run real return, around 7%. After 10 years, she's around 35 grand. Not crazy different. After 20, she's already at about 100 grand. After 30, she's around 240. And after 40 years, she's roughly $500,000. The gap widens dramatically, especially later on. Ivy's returns start compounding on larger amounts. Her money makes more money. It's not magic, it's geometry. Exponential growth rewards time more than effort. Start earlier and Ivy pulls even further ahead. And the key detail is this: the curve doesn't look impressive early. The math is patient. It waits for the late stage explosion. Here's where the story gets almost poetic. For Saving Sam, the curve stays gentle. His wealth grows steadily, but never accelerates much. He reaches retirement with security, but not abundance. For Investor Ivy, the real wealth happens late. After 30 to 35 years, her portfolio can start generating tens of thousands in a good year, more than her monthly contributions ever did. The engine starts to run itself. Think of it like two trees in a forest. Sam's is sturdy, but stays small. Ivy starts slow, but once it breaks the canopy, it captures sunlight exponentially. The mass accumulates at the end. If they both maintain discipline for 40 plus years, Ivy's probability of meaningful wealth is dramatically higher. And if you're still here watching long-term wealth math, you're exactly who this channel is for. Tap subscribe to help support the channel and let's keep going. Now let's do the most important test in this entire video, because the spreadsheet version of Ivy is basically a superhero. She invests every month for 40 years like a robot. No interruptions, no emergencies, no fear. But real Ivy isn't a robot. So let's stress test the story. Same Investor Ivy, same €200 a month, same long-term average return. But this time, life happens. Let's say everything goes smoothly for the first 20 years. The curve is finally starting to bend upward. This is where the engine is supposed to kick in. And then Ivy gets hit with a completely normal chain of events. A job loss, rent spikes, a family emergency. So she stops contributing for 5 years. Years 20 to 25. Notice something. Early on, skipping 5 years doesn't look catastrophic. But late in the timeline, those years are not equal. They are expensive years, because those are the years where her portfolio is supposed to start compounding on a larger base, where each additional year has outsized impact. Now make it worse. What if during those same 5 years she doesn't just pause? She's forced to pull money out, not because she's reckless, because she needs it. Maybe she withdraws a chunk right when markets are down. This is the part nobody understands until it happens to them. Compounding isn't just about adding money, it's about protecting the base. When you remove money late, you're not just losing that amount, you're deleting the future growth that amount would have created. So Ivy's path is powerful, but fragile. Not fragile like it doesn't work. Fragile like it requires staying alive financially long enough to let it work. And that's why the gap between Sam and Ivy isn't just about returns, it's about resilience. Because the math rewards time, but life keeps trying to steal it. So why don't we see more Investor Ivys in the world? Because life isn't a clean graph. Friction intervenes, constant invisible forces that flatten even the strongest curve. Sam and Ivy both face the same shocks. Income interruptions, job loss, illness, forced pauses in contributions or withdrawals at bad times. Housing costs in places like capital cities eat savings just as compounding should ramp up. debt compounds against them, loans at 5 to 20%, while investments grow at around 7%. Emergencies demand cash right when markets are down, forcing sales at lows. Behavioral slips, panic and crashes, chasing trends, or simply stopping when life gets hard. Each hit costs exponentially more for Ivy because her curve is steeper. Missing years late hurts far worse than early. Sam's flatter path is more forgiving of interruptions, but it never reaches escape velocity. So the math doesn't fail. Staying in the equation, especially Ivy's riskier one, is what fails most people. Wealth isn't about picking winners or being the smartest. It's about durability. The people who end up wealthy aren't always high earners or market geniuses. They're the ones who keep contributing through boring years, even small amounts. Avoid catastrophic debt or spending blow-ups. Survive shocks without derailing entirely. Resist interrupting the process with panic or greed. Saving Sam can win with extreme caution. Investor Ivy wins bigger with good enough consistency and damage control, because in her world the curve is powerful, but the price is resilience. Small habits compound too. Automatic transfers, no lifestyle creep. Boring endurance beats brilliance every time. The math of money is patient. It waits for you to outlast your own life. Sam and Ivy show us two paths, one safe but limited, one powerful but demanding resilience. The real question isn't which one are you, it's how long can you stay on your path? If this breakdown resonated, subscribe for more calm looks at how money actually works. Quick poll in the comments, are you more like Saving Sam, safety first, or Investor Ivy, growth with risk, or somewhere in between? What's the biggest friction holding your curve back? Thanks for watching, stay consistent and stay curious.